Yeah, hi everyone. So, being a tax guy, these finance tools, AI, these finance transformation is quite boring for me, and to be very honest. And sorry if this is offensive for anybody, but as we talk about tax payments, tax savings, and value addition for the organizations. So, the only if you see this airport, you'll find that this airport has the maximum number of emergency exits. So that's why it is named after it. Anyway, I usually start with a joke. So, what is indirect tax efficient supply chain? What do you mean by that? So basically, everything starts from a PO, a purchase, and then it is culminated into a sale. So from the first purchase till your last sale, as a finance head of the company, you have to ensure that there are no indirect tax leakages. And when I'm talking about indirect tax, I'm talking about GST and customs, not these local taxes like octroi and mandi tax and all those taxes, which are somewhere still available, applicable. So you have to optimize all of your taxes, and there is no leakage. That is what you have to ensure. And after this session, you will find that there are many schemes, many options available to the different organizations. They can save crores and crores of taxes. And as a finance leader, of course, it shows that our organization is tax efficient organization. And if an organization is tax efficient, you know that you can be the next Reliance. Because as a chartered accountant, the first thing we were taught in direct tax is that Reliance has got their money all from taxes and all those things. So you can imagine the impact of saving and optimizing your taxation. I being an indirect tax professional, I'll only talk about indirect tax efficient supply chain. So we start with the GST part first, and then we move on to how from purchase to sale we can save our taxes. So my first question to you is that, so when we talk about supply chain, that means we are talking about our customers, we are talking about our vendors. Okay, we have purchases, we have sales. Purchases may be expenses, and so we are talking about vendors and customers. So my question is, e-invoice is applicable on your vendors issuing your invoices who has more than 5 CR turnover, 5 crore turnover. So there are many vendors you must be having. Are you checking that they are issuing e-invoices? In most of the companies, no. Because there is no tool available.
Yeah.
However, it directly impacts your ITC, input tax credit. So whatever you are buying from a person who has a turnover of more than 5 CR and they are not issuing an e-invoice, they are only giving you an invoice, you are making payment, your ITC is ineligible. So your optimization is crying in the corner. Second, ITC reversal by dealers and distributors. So you must be giving some discounts, target-based discounts to the dealer and distributors, and issuing a credit note, GST credit note. So there is a condition under the law that your dealer has to reverse the input tax credit, because earlier he have purchased goods from at let's say 100 rupees at 18% GST. Now you are giving a credit note for target-based discount, and then you are reducing your tax liability by way of GST credit note. The condition is that your dealer has to reduce it at the same time. This is the second condition. Are you checking that? You cannot, you have thousands of distributors. How would you be able to maintain this check? Again, your GST liability you cannot optimize from this one. Of course you can optimize, but you have to have some checks and balances. We are not going into the depth of how this can be done. Tax disclosures by your vendors and tax payment by vendors. This has been the burning issue for the last 4 or 5 years. and this will be the issue for next 4-5 years. Another point is disclosures and tax invoice by transporters. So your transporters who are GST registered, who has taken GST registration, are not issuing you tax invoice of disclosing their tax liability on the portal. Although you have to pay their tax under reverse charge, that means you will have to pay yourself. But when your transporter is a registered person, then the responsibility of issuing a tax invoice and disclosure in its form GSTR1 is lying on the transporter itself. Then the fifth point is correct invoice issued by vendors. So we are facing so much of litigation where your vendors are issuing invoices on some other GSTN and sending goods on some other GSTN. They are mentioning different place of supply, and suppose you have purchased goods from Delhi to Gurgaon, they have issued the invoice properly, e-way bill, you have got the goods. Now while filing the return, they are mentioning POS as Uttar Pradesh. Your ITC will be denied. As simple as that. So, and these are the 6 points that it creates a tax efficient supply chain from a GST perspective when it comes to your vendor and your customer. These are the only 6 points. The 6 point is payment within 180 days to vendor. So if you don't make payment within 180 days to vendor, your ITC will be denied. Now, ITC leakages. We are having construction of buildings, offices, and as per the GST law, ITC is not available on these services. However, you can optimize your ITC by segregating the agreements into 2 parts. One is for construction, civil works, immovable property, and other is for movable property. For example, you have an agreement wherein you are buying movable property also. For example, AC, fan, chair, glass doors, glass tables. In the entire contract construction of building, you can segregate these contracts and optimize your ITC. Another point I have seen is that event management and separate services. For example, this is the event being managed, let's say by Holiday Inn. Now, you may have different vendors who are supplying food services, who are supplying, let's say, hotel services. You're having different bills, hotel bills separately, food bills separately, and there is an event management team separately. So instead of getting these separate bills, you can ask the event management team to handle the event, including food, hotel services, everything themselves, and raise an event management bill. So thereby you will be eligible for credit of the entire services. You are not eligible for food services. And I also receive a query regarding travel. Your travel agent is charging you GST, creating a cascading effect. So what they are doing, they are adding their commission as well as whatever the airlines they are paying to airlines. Now airlines is also charging GST on the air fee, and then your air travel agent is including the entire airline charges including GST plus their commission and then charging GST. So this is the cascading effect they are creating. You can also solve that. Then there may be ITC accumulation. You have multiple units, and in certain units there are ITC accumulation. But you have multiple businesses. For example, you have a business of 5% GST rate, you have a business of 18% GST rate, 12% GST rate. So you can also liquidate ITC accumulation by multiple ways, and there is a legal ways. I am not asking for issuing the fake invoices. First is combining business. You can combine your 5%, 18% business. You can route your outward supply through different GSTNs. You can route your inward supplies through different GSTNs, and liquidate your this ITC accumulation pot. So these are the overall, these are the examples. There are multiple points where leakages are there, and these 2 slides pertaining to GST will show you that under GST you can achieve the full indirect tax efficiency. That your ITC is not leaked, your vendors are doing good, your vendors are doing all the compliances, And your customers are also doing the compliances where your GST is impacted. For example, dealers and distributors. Now, we go to the entire chain from purchase to sale. You may be an exporter manufacturer, you may be a domestic manufacturer, you may be an exporter service provider, and you may be a domestic service provider. Okay? And we are discussing all these 7 scenarios. Of course, if you are an exporter manufacturer, you will have multiple options. But we'll start with the domestic manufacturer. That means whatever you are manufacturing, you are supplying to the domestic industry. There is no export or very okay. Then what are the benefits available to you? Anybody can tell me what are the benefits available to you from an indirect tax perspective? Okay, so you must be importing raw materials, or you may be procuring it from India only. So you are a domestic supplier, you are a manufacturer and a domestic supplier. No exports or negligible exports. Think of that in mind. So for manufacturing goods in India and for supplying those goods in India, you may be procuring raw materials from India, or you may be importing the raw materials. Okay. The question is, are you eligible for some benefits? You can save the duties, customs duties or GST on the import of those raw materials, or even from procurement from India. The answer is yes. If you are importing the raw materials, you can avail and lower rate of duty, and there is an option of advance authorization. Then there is free trade agreements with different countries, and then there is a mover scheme, which is a bonded manufacturing scheme. You must have heard of. It is also a quite burning issue these days under customs. These are the 4 options you can avail, and we'll discuss it one by one. Exemption or lower duty rate. First of all, you have to identify the exemption. So there are hundreds of exemption notifications. You have to identify which exemption notification is applicable on your raw material. Okay, that identification is very important. Second, and there can be multiple exemption notification applicable to your raw material. So you can choose wherever the conditions are suitable to you to avail those exemptions. Second is HSN analysis. HSN analysis becomes very important when we talk about finding the correct rate of duty. There may be a situation you are paying higher rate of duty and you should have paid the lower rate of duty because your HSN classification was wrong. So I have given an example. For example, this is what we have done in one automobile sector component manufacturer who is manufacturing CNG kit. So the pressure measuring apparatus can be classified under 9026 and can be classified under 9031. The entity was classified under 9031 and paying customs duty BCD at 15%. The correct classification is 9026, where BCD is nil, 0 BCD. So it is important to analyze your HSN code also. There may be a situation you are paying higher duty than what you should have been paying. Second is advance authorization. So if you are a domestic manufacturer supplier, you can import your raw material on advance authorization. Now advance authorization has an export obligation. You are not an exporter. How you will fulfill the export obligation? So advance authorization scheme states that you can export, physical export or deemed export, or there can be third party exports. That means you can physically export, that is not available to you. You can make deemed exports. Deemed exports are, you can give your product to any advance authorization holder. Further, you can give your product, you can sell your product to any EPCG holder. For example, you are a manufacturer of capital goods. Then the EPCG holder may buy it from you and you can buy the raw material at advance authorization. So you can supply your goods to a party who is also an advance authorization holder. Okay. Now there is a condition of 15% value addition. This is another scheme for domestic manufacturer suppliers. Free trade agreements. There is no obligation. So we have multiple free trade agreements with different countries. So these are list of bilateral free trade agreements, and these are 13s. These are bilateral, and those were different regional free trade agreements. So there are 13 free trade agreements India is having right now. So BCD and SWS is completely free. So for example, if you are importing coal from Australia, okay, you don't have to pay any BCD or SWS. If you are importing certain electronic products from Vietnam, Singapore, you don't have to pay any BCD or SWS, or Thailand. So there are these countries from where your entire imports will be duty free. Another area is bonded manufacturing. This is merely a duty deferment scheme. So usually from a raw material perspective, we don't suggest that until you have a larger, supply chain cycle, that you're importing raw material today and you will be supplying, say, after 6 months. You have some sort of seasonal product, being manufactured at your plant. So this is merely a duty deferment scheme. Unless until there is a huge working capital benefit for raw materials, it is not advisable. However, if you want to have an anti-dumping duty or a safeguard duty arbitrage, for example, you are importing a chemical from China, or you are importing certain goods from China, and there is an anti-dumping duty, okay, and you are going to import in a huge quantity. So what you can do is you can have a mover warehouse. You can import all the goods right now, and there will be no duty. When the anti-dumping duty sunset will come, the next day you can clear those goods. So at first you are importing those goods without paying any duty in your mover warehouse. After the sunset clause comes, the next day you clear it. So this is an arbitrage with the mover scheme, and this is very important arbitrage. Raw material procured from India, so those were the imports. If you are procuring raw material from India, then also you can get the benefit. You are not an exporter and you are procuring raw material from Indian vendors. Still there is a benefit. How? If you are making supply to EOU, SEZ, advance authorization holder, EPCG holder, if your product is being sold to these categories, then you can avail advance authorization. And you can purchase from the vendor who is also having advance authorization. So there will be no duty incidence of the imports done by your vendor, because if your vendor is not availing import benefits, then he will bill those BCD as SWS in their invoice to you, and then there will be cascading effect of indirect taxes. So even if you do not have any export and you are importing from Indian vendors, you can still avail, you can still explore these duty benefits. Now you are a domestic manufacturer and you are going to have expansion in your business. You are importing capital goods. We talked about raw material, this is capital goods. You can import, you can buy from India, then import. You have EPCG scheme for deemed export, third party export. So you have the EPCG license, and there is an obligation of whatever duty you save, 6 times of that amount, that duty saved will have to export. It can be deemed export also. Deemed export is you can sell it to another EPCG holder, your products. You can sell your products to advance authorization holder. You can sell your product to EOU, SEZ. And also you can sell your products to third party who is exporting further. So you can still avail EPCG scheme if you are a domestic manufacturer supplier. No need for these physical exports. Exemptions are there as we discussed. Free trade agreement is also available on capital goods, and bonded manufacturing scheme, which is for raw material it is not advisable, but for capital goods it is still advisable. Capital goods procured from India, of course you can avail EPCG scheme, buy from TTA vendor having advance authorization, you can buy from EOU and SEZ area also. State incentive and IDT efficiencies. So you are having an expansion in one of the states and states are giving you benefit in form of net SGST paid in cash. So whenever you will have the states. So this is a link with the state incentive. Another part, we recently did this exercise for an ethanol plant. So our client had this established an ethanol plant in Rajasthan. So they have this scheme of giving net GST in cash. Whatever you pay in net GST in cash to the state government, they will give it back to you for 8 years or for 7 years. So simply by doing this 4 exercise, they have saved 8 CR of extra state incentives. What we did, so when you establish an ethanol plant, so there are 2 products, ethanol and DDGS, which is a co-product. So we explore 4 options. Purchase your plant IGST, that means interstate. Sell your DDGS interstate for 2 years and then intrastate, and sell your ethanol intrastate only. Second option we explored, purchase your plant intrastate. Ask your vendor to bill it to your Rajasthan, and then vendor will bill GST and will bill it to you. So you get CGST as GST. Selling your co-product interstate for 2 years and then intrastate, ethanol only intrastate. Purchase plant intrastate and sell all products intrastate. Purchase plant interstate and sell all products intrastate. So doing this exercise, we got to know that the 4th option is the best. That we are getting 6 to 8 crores of extra incentive just by doing this mathematical exercise. And it costs you nothing. It costs you a negligible amount of doing this exercise. I just take 2-3 minutes. Then exporter manufacturer, again, if you are not a domestic supplier, you have exports. You can be SEZ unit, you can be EOU, you can be a DTA unit. SEZ, EOU obviously have a separate scheme which is in fact inbuilt. The entire efficiency is inbuilt in those schemes, so you don't have to worry. If you are a DTA scheme, for raw materials, you have exemptions, advance authorization, jobbing exercise. For example, your supplier who is sitting, your importer who is sitting outside India, is supplying raw materials to you. You just have to assemble those raw materials or maybe work something and send back to the supplier. That is called jobbing exercise. So you can avail all the duty exemptions. For example, there is an export order with you. Your importer is not sending you goods. You are purchasing it from somebody. But you can ask your importer, what you can do is you purchase directly at a high C sale and then sell to us as a high C sale. In that case, your importer will become a supplier of raw material. Then these exemptions will be available to you. So this planning can also be done. Free trade agreement and again bonded manufacturing. So we have already discussed. Capital goods, again you have these exemption FTA, EPCG mover, and there is another scheme, project import, where it is a lower duty. Export benefits, this last slide I will discuss. Of course, when you export goods, there is a benefit of road tax from a percentage, 1%, 2%. Then there is a drawback benefit. Now this is an important benefit which people are not availing. When I say drawback, there are 2 types of drawback. One is all industry rate, another is brand rate. Okay, all industry rate is you sell 100 rupees of goods outside India, you get 1% drawback, that's it. And this is what everybody is claiming, 1%, 2%. However, your product which you are exporting has a duty incidence of 15%. Then you have to get all that 15% from the government, because we have to export the goods, not the taxes. This is what the government policy is, and brand rate scheme ensures this policy is implemented. That under the brand rate drawback, you will get 15 rupees of drawback instead of just merely 1 or 2 rupees. So this is an important benefit that exporters are usually missing. You are manufacturers. For service importers and exporter also, there are benefits of EPCG scheme. So if you are a service provider and exporter, you can still avail EPCG scheme, and by services also you can fulfill the obligation. Then you have again jobbing is there for you. As far as benefits are concerned, there is one benefit for exporter of services, and that is GST refund. Nothing else. Thank you.
Thank you.